Ooh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. Let me ask you something that sounds impossible. What if a company could make its profits go up without selling a single extra item? Seriously, it sounds like some kind of accounting magic, right? Well, today we're going to solve what I call the profit puzzle by diving deep into two competing accounting methods, absorption and variable costing. So here's our game plan for cracking this case. First, we're going to lay out the mystery itself. Then we'll investigate our two main suspects, these two costing methods. After that, we'll find the single clue that explains everything, see how it all plays out with a real-world example, and finally, figure out when to use which tool for the job. All right, let's jump right into the mystery. Now, this is a concept that seems to fly in the face of all business logic, but, and trust me on this, understanding it is absolutely crucial if you want to really know what's going on with a company's finances. So here it is, the big question. Imagine for a second your year-end bonus is tied to net income. Could you actually make your bonus bigger just by telling the factory floor to produce more stuff, even if that extra stuff just sits in a warehouse unsold? Could you literally manufacture profit? And the absolutely wild answer is yes. Yes, you can. It feels like a bit of an accounting trick, and honestly, in some ways it kind of is. This whole strange outcome boils down to a choice between two totally legitimate but fundamentally different ways of counting up the costs of production. And that brings us to the investigation phase. It's time to meet our two suspects in this whole profit puzzle, absorption costing and variable costing. On the surface, they seem pretty similar, but there is one key difference that, well, it changes everything. Okay, suspect number one is absorption costing, also known as full costing. The name really says it all. Each product you make absorbs a little piece of every single manufacturing cost, kind of like a sponge. So yeah, that includes the obvious stuff, the raw materials, the labor, but it also includes a slice of the big fixed costs, like the rent for the factory. This is the all-in method, and it's actually required by GAAP, that's generally accepted accounting principles, for any official reports you show to the outside world. Suspect number two is variable costing. Now, this method is a lot more straightforward. It says, look, only the costs that actually change when you produce another unit, like materials, should be attached to the product. All those fixed costs, like that factory rent we talked about, they're treated as an expense for the entire period. They hit the income statement right away, no matter how much you produced. This is why it's such a fantastic tool for managers making decisions inside the company. And this visual just nails the core difference, doesn't it? With absorption costing, you can see a chunk of those fixed overhead costs gets tucked away inside your inventory. But with variable costing, nope. The whole fixed cost gets expensed immediately. And this one little difference leads to two totally different use cases: absorption for your official external reports and variable for making smarter decisions internally. Okay, we found it. This is the smoking gun, the entire reason for our profit puzzle. The whole shebang, it all comes down to how we treat one single account: fixed manufacturing overhead. This is the core clue. Let's just break it down nice and simple. As you can see right here, both methods agree on almost everything. Direct materials? Yep, include it. Direct labor? Check. Variable overhead? They both agree. The entire fight, the whole disagreement, is on that one bolded line: fixed overhead. Absorption says include it. Variable says nope. Do not include it. That's it. That is the whole game. So let's really think about what that means. With absorption costing, every single car you build has a tiny piece of the factory's annual rent attached to it. Now, if that car doesn't sell this year, that little piece of rent doesn't get counted as an expense this year. Instead, it just sits there, on the balance sheet, quietly hiding inside the value of your unsold inventory. But variable costing? It's way more blunt. It takes that entire pile of fixed overhead for the year and throws it onto the income statement as an expense, right now. It does not care if you sold one car or 1,000,000 cars. That full cost hits your profit for the period, no questions asked. Okay, enough theory, right? Let's put some real numbers to this. This is the revelation. This is where we get to see exactly how a manager can, like magic, create more profit just by building more cars. Let's get into our case study. So here's the setup. We've got a car company. Over the course of a year, they produce 6,000 cars, but they only managed to sell 4,800 of them. And this is the absolute key to the whole puzzle. Production is higher than sales. Their total fixed manufacturing overhead for the year is a cool $1.2 million. Okay, first up, the official income statement using absorption costing, the one they show to investors. We start with our sales revenue, pretty simple. From that, we subtract the cost of goods sold, which, remember, has that fixed overhead baked into it. That gives us our gross margin. Then we take out the other business expenses, and we land on our bottom line, our net income. Now burn this number into your... So the official reported profit to the world is $3,528,000. Got it? Let's lock that number in. Now for the big reveal, let's look at the exact same year, the same sales, same everything. But we're going to run the numbers using variable costing. Now, the format's a bit different here. First, we calculate something called the contribution margin. That's basically the profit left over to help cover our fixed costs. And once we subtract all of those fixed costs, well, just look at what happens to that bottom line. The net income is, well, it's not the same. $3,288,000. Wait a minute. That's almost $250,000 less than what we just saw. How? How can the same company in the same year have two different profits? Where did the money go? And here it is, the solution to our mystery. The difference in profit is exactly $240,000. That is not a coincidence. The company made 1,200 more cars than it sold. Under absorption costing, a piece of that $1.2 million overhead got attached to each of those unsold cars. That piece totals up to $240,000. And that money never hit the income statement as an expense. It's still sitting there on the balance sheet, hiding in the inventory account. So if we get two different answers from these two methods, which one is the right one? And the answer is, they both are. They're just different tools designed for different jobs. So let's talk about the application and when you use which one. So, which tool do you pull out of the toolbox? Well, for your official external reports, you don't have a choice. You have to use absorption costing. The IRS and GAAP demand it. But inside the company, when you're trying to make smart decisions, variable costing is often a manager's absolute best friend. It gives you a crystal clear picture of what it really costs to make just one more unit. And that is golden for planning and analysis. And this right here, this is the ultimate cheat sheet. It gives us a simple set of rules. When you produce more than you sell, your inventory grows, and absorption costing will always show a higher profit. When you sell more than you produce, maybe you're clearing out old inventory, variable costing will show the higher profit. And if by some miracle production and sales are perfectly matched, the profits will be exactly the same. It's a direct, predictable relationship. And all of this leaves us with one final, and I think really important question to chew on. If an accounting method can show a higher profit not because you sold more, but just because you made more, what does the word profit truly mean? When you look at a company's bottom line, how much of that is real economic performance, and how much is just a reflection of the accounting method they chose? It's definitely something to think about. Thanks for helping me solve the puzzle today.